Welcome to our latest TokStocks Podcast interview with Connie Marples, founder and CEO of Boosh Plant-based Brands. Connie is an inspiring leader in the world of plant-based food, and she has made it her mission to create delicious, nutritious, and sustainable food options for budgets all kinds. Boosh is a company that is changing the game when it comes to plant-based cuisine, with multiple products and brands covering frozen, fresh, and shelf-stable snacks. With its 2022 acquisition of leading bean chip brand Beanfields, carried in 7,000 stores in North America, investors have started to catch on. Its shares have recently re-rated higher and seen a huge increase in share trading volume. In this interview, we will explore Connie's background, her journey as founder of Boosh, and the exciting things that are happening for the company. So sit back, relax, and get ready to be inspired by Connie Marples and the work she and her team are doing at Boosh Plant-based Brands.
Alrighty. Hey, welcome to another edition of TokStocks Podcast. Today we've got Connie Marples, founder, CEO of Boosh Plant-based Brands. Trades under the ticker VEGI on the CSE. Anyway, so we're going to sort of have a good deep dive here, ask her some questions on what's going on with the business, learn a bit more about the CPG side of it. It's obviously been a very high trading stock here recently, a bunch of new investors that are now shareholders of the company, and including myself. And we'd love to, get a bit more of an understanding of just what we sort of own and a little bit more about Boosh and some of its brands. So, Connie, welcome. Thanks very much for joining us today.
Appreciate it. Thanks for having me.
Awesome. Maybe you could just start off by giving a little bit of a background on yourself and sort of how you came up with the idea for Boosh and whatnot. Would you mind?
Sure, absolutely. Well, I've been sort of a serial entrepreneur most of my life. My background's everything from large scale outdoor event management to restaurant. I had the first wine bar in Canada. With a wine store attached to it about almost 20 years ago. So I love this space of food for sure. And I'm always generally kind of aware of what the trends are and what people are looking for, whether it be an entertainment style or what they're wanting to eat. And the better for you foods is certainly what everyone's looking for right now. So happy to be involved in this stage of the CPG industry.
Excellent. Well, with that, what sort of inspired you to pursue a career in CPG, and what do you find most fulfilling about your work today?
Well, I started out with Boosh, and the name Boosh comes from mouth. It's one of the one words Canadians all know in French, right? Boosh, fermez la bouche. So it started out, it was going to be mostly an online store. So we were doing home delivery, started in a small kitchen, just helping people eat quick, healthy meals. We started with the Boosh Bowl, and it became very popular in the sort of lower mainland area. It's difficult to scale that business without investing a lot of time and money into logistics. So we went from there and decided we wanted to go into retail. And that front line with the customer really helped us develop our flavor profiles, what people were looking for. And that's how we got into retail in late 2019. And it's always been my passion to help people eat healthy, whether it's sharing with friends and family. I have a huge family. I'm like that favorite aunt. I've got a gazillion nieces and nephews, but also to take that to the masses, because people are busy and we want to be able to offer good options. And of course, now our portfolio includes Beanfields chips, which is our primary asset. And that's a wonderful product that, eats like a Dorito, but doesn't make you feel terrible after. It's a much better for you solution for snacking. So
yeah, excellent. They're in my pantry, and we often go to them. They're great with some hummus. Fantastic. Yeah. And I'm a big fan of Doritos, but they're not nutritious in any way. And as I'm getting a little older, it's important to start to eat a little better. So big fan of what you're doing with Beanfields. So what sort of, you kind of talked a little bit about, trying to do healthier eating habits and stuff like that. When did you actually sort of originally found Boosh and the Boosh bowl? When did that sort of kind of come to life in your head? And when did you formally get started?
In 2016 is when I started kind of planning things out. I was actually in real estate with my husband, and very, it was a very good market, very busy, but I just wasn't getting my passion fulfilled. So I started planning Boosh as an online program, and didn't launch it until 2018. Late 2018, and in a small kitchen in Ocean Park out in White Rock area. And then it took us about a year almost to get into retail. We kind of did all our sales direct, launched with the Sobeys natural program, the local program, I should say, and a lot of local retailers picked us up. And my son and I worked together, and we kind of hustled all over the province and got launched in about 150 stores. And then from there, right in early 2020, our first quarter of 2020, which was our second quarter of the company in retail, we were doing very well. And then, of course, we all know what happened in March that year. That's when COVID hit. So it became very challenging to get out to stores. They wouldn't even answer the phone at that time. It seems so weird to think back, right? But we couldn't deliver. Because at that stage, when you're really small, you have to do everything. You've got to go in the stores, you got to fill the orders. They just won't bother keeping you on the shelves unless you're in their planogram already. And so young brands, you have to hustle. So we basically at that point realized we have to either go big or go home right now. So at that point, we got a national broker and a national distributor, because that way you can at least get in the door. And we expanded across Canada with UNFI at that time and started picking up accounts across Canada. And at the same time, that's when we ended up going public, because we were looking for various funding mechanisms, and we were approached by a group that decided that was the best path for us. So it wasn't my original intention necessarily. I mean, I've always loved the public markets. I find it very exciting and interesting. And I was pleased that the opportunity came up.
Excellent. So just before we kind of jump in and learn a little bit more about your brand portfolio, because it's now more than like the Boosh bowl. You've got your Beanfields chips and things like that, and some other interesting products that I'm not sure if all the shareholders or investors fully understand. But maybe you could just talk a little bit about sort of your ethos and leadership style. And you talked a bit about having a hustle. Sounds like you've had to wear many hats, all the hats, and lead by example. Could you just speak a little bit about your sort of leadership style?
Sure, absolutely. Well, I've always believed, because we are a mission-driven company, we are looking to help people eat healthy, or we're not telling everyone they should be vegan, but we're telling people that we need eat your vegetables. I'm the mom or the aunt telling you to eat your veggies. So it sort of stemmed from there. We want to do better for our bodies. We want to do better for the planet. We have a very good work-life balance, even though we all work very hard. We're quite flexible in terms of allowing our staff to, work partly from home, be able to pick up their kids to take them to soccer, and then they go home and they finish the day. Those kinds of things are really important. And when I'm looking for hires, I'm looking for people that bring a real spark to their work day and to their lives, and people that are really passionate, just lit up. And I try to live that way, and I try to inspire our team to be that way. We're a small group. We all work hard, but we have a lot of fun, and everybody has really good interests outside of work. And I think it's super important to just live life with a good, happy base, and that's where we come from.
Excellent. And are you guys have an office, or do you work remotely now?
No, we have an office in Cloverdale. Originally, we had quite a large space because we were going to build out a facility for Boosh. But then once we got the Beanfields acquisition, which is primarily in the US and done through co-manufacturers, We moved into a small space to lower our overhead, but it's great. We're in Cloverdale with about 2,000 square feet. So just enough space to keep samples and our packaging and have offices for the 6 of us. And it works really well. Keep the overhead down.
Excellent. Excellent. Well, I'm sure investors like to hear that. Keep the overhead low.
Yeah.
What advice would you give to any aspiring entrepreneurs who are looking to start their own food or beverage company? What qualities or skills do you think are essential to have success in the industry?
Well, people from all backgrounds can do well in this industry, even, if you come from a completely non-related field. But I guess the biggest thing is you have to know that you're going to need more money than you think, and it's probably going to take longer. Maybe 1% blow up overnight. I'd say it's less than that. So you have to be really willing to work super hard. And if there's a way that you can not take a pay, like I've had to do, and many entrepreneurs have to do, that's huge, because you can't expect to be going in and if you're getting paid 70,000 or whatever you're making at your current job, don't quit your day job until you're really balanced. So maybe keep it as a side hustle to start. And it's not for everyone to go big either. Like sometimes it's better to just keep it as a small local product, and that's really great too, because once the further into it you get, the more expensive it gets, because it's the big machine, right? And you got to be ready for all that and keep a good solid, keep your vision and keep positive.
Excellent. Well, thank you. Maybe we could dive a little bit more into Boosh and its portfolio. Could you kind of explain or mention like the brands that you own, and I assume are they all 100% owned by the parent co, by Boosh,
Yes.
The pub co?
Yes, exactly. So I'll just briefly describe. Boosh has the most products, but it has the least sales at this point, and mainly because we purchased an asset, Beanfields, which has been around since 2010. So we're in kind of a unique situation in that regard. So I want to just first talk about the Boosh products, though, to kind of let you know on a timeline how we came to be. So we started with a frozen line, which I mentioned, and got into grocery. Then our first acquisition was a small one. We purchased a powdered cheese company out of Montreal, and it tastes just like sort of nacho cheesy, cheddar cheesy flavor. We have 2 flavors that we further developed, and now we have a shelf-stable mac and cheese product, which is great. Comes with brown rice organic pasta, and then the powder itself that is made, the first 3 ingredients are nutritional yeast, tapioca starch, and pea protein, as opposed to salt, sugar, and hydrolyzed fat, which the competition, even the healthy brand competition is. So it's a really unique product. And then we purchased a company called Pulse Kitchen out of Penticton, which is a artisanal sort of cheese company made from seeds, nuts, really delicious cheeses. And we also purchased Salt Spring Harvest Veggie Pate. And we took those 2 lines and we rebranded them into Amuse-Bouche, which for those that don't know what that means, it's that little free tasty appetizer you get at fancy restaurants. And it technically means to amuse your mouth or small bite. So it's kind of cute and fitting for that line of products that fit well with parties, charcuterie, that kind of thing. And then the other product we have with Boosh is a chill line, which is delicious chili gravy, mushroom gravy, which can be used as a soup, and sloppy joes, and those come in a pouch in the chill section, and those are really premium products. And then finally, and most importantly, is a Beanfield is a chip out of the US that was founded in 2010. It's made from beans, of course, rice, very simple ingredients, spices, and oil. That's it. So it's a really nice product. The original founders developed it in 2010, sold out in 2016 to a group of investors who did a great job of building top line revenue. They got it all over North America. They did really penetrated the market well, but they didn't concern themselves with the back end. And I know that's a strategy. And it can be a good strategy, but the money got expensive and it caught up with them. And so when COVID hit, that was a really tough time for them. At the time, they decided to really expand their SKUs and offer a whole bunch of different unique products, and probably would have been the best time to dial back and just focus on their top sellers. But it was a play at the time, and it came back to sort of hurt them. So the revenues went down during that period of time, as did lots of food companies for that matter. So when we purchased them, the previous year they had done 8 million in sales, US that is. So they went into a friendly foreclosure. We purchased from the lenders for 8 million shares in our company. And we had to provide $1 million operating line, and we took on a $400,000 loan. It's kind of our whole portfolio. I know I kind of ran off with the Beanfields, but I do get excited talking about it. We're so happy to have that asset, and it's been a journey for sure the last year in kind of tidying up the back end and getting everything organized, and we're off to a really good future here now that we've got that. We're happy to be moving forward with it.
Fantastic. Well, we'll dive a little bit more into Beanfields here in a few minutes. That's obviously one of the things that's got me kind of interested is, just from somebody that's invested into CPG and understand brands and have friends that are, growing, trying to, develop and expand brands, getting to sort of, 5 to 10 million in sort of annualized sales. It's not very common. A lot of people sort of fall down before that. Just not being able to get product market fit and being able to get something that consumers will buy en masse. So sounds like Beanfields, you sort of got that product market fit. They did some of the heavy lifting, and hopefully now you've been able to sort of acquire it and refine it a bit and get it set up for its next big sort of growth trajectory. So just to go back to kind of Boosh, the Pubco, it went public a few years back, and I guess your sponsor, the broker dealer through Haywood, it's largely sort of known for mining. Yes, they do other things, but that's what they're sort of primarily sort of known for. How was the experience for you? Was it a good one?
Yes, very much. It was a different time. Of course, the markets were very different than they are now. I'm grateful to them in the sense that they set up a really good structure. They didn't over raise. They didn't, some of the some of the plant-based companies that went public during that time, their structures weren't as good as the one that we were set up with. So we did small raise and kept it tight. And that sort of afforded us to make acquisitions, do raises for the acquisitions and issue more shares. And had it not been for the way they structured it, the way they did, it's very unlikely we would have been able to get Beanfields. So that was a big
great.
Yeah.
That's great. Well, I'm glad you had a positive experience. It can be a little bit of a mixed experience for entrepreneurs that are passionate about their business. It's kind of like having to take on a second business. You've got the business of the operating company, and then you've got the business of the capital markets, which can be a whole other sort of ball of wax. So glad it was a good positive experience for you. Excellent. Well, maybe you can kind of talk, a little bit about, there's all this buzz, with your company, and most of the chatter that I've sort of seen has been a lot about this Beanfields chip brand. You've talked a little bit about how you acquired it, and I guess you were a bit of an opportunist there when they were having a bit of problems during COVID and whatnot. How many products does it have? And what are its products, and how many SKUs? Are you looking to refine those or expand on them? Come up with different pack sizes or formats? Where are you sort of seeing the growth? And is there any competition that you're concerned about with the brand?
Okay, so if I forget any of those questions, you fill me in later. First of all, we already have scaled back the amount of SKUs, because like I mentioned, during COVID, they went really in my opinion, overboard. Like they had an expansive amount of them, and some of them were seasonal, like cocoa and pumpkin and stuff like that. So we looked at what the top sellers were, and not only that, we looked at the ones that our main retailers were carrying, because that's who we needed to focus on first. Is we want to keep those big accounts happy because they produce a huge amount of the volume. So we've got about 7 flavors that we're producing now. And the nice thing is we can reintroduce flavors if we want to, but some of them were a little redundant. They'd have like a jalapeno and a jalapeno lime and a jalapeno nacho, right? And a nacho, right? Well, we've tasted them and we're like, they're not that different. And if this one's selling way down the list, those buyers are going to flip over to the other flavor, right? So we've done that work. And they did have another line of products that was just launched prior to, I guess, about 2020, sorry. And it's the rings. And so they're like a Funyun. And they had 3 SKUs of them, and they did under $1 million in sales over a year and a bit, which is actually pretty good to launch. But they're extremely expensive to make because you get them, the rings are made here, and then they have to be shipped to another place to get the spices put on, and then shipped again to be packaged. So it's just like at the end of the day, you're paying people to eat them. So we are looking to reintroduce those at some point, because we've now found a better way to make them and produce them, that there's actually money left on the table, which is a nice thing. But in the meantime, we'll just leave that. Yeah.
Great. So I guess you're focused in on kind of top sellers.
Yeah,
And
absolutely.
How many SKUs do you support now between, I guess, in North America, between US and Canada, for Beanfields?
So we're doing our 4 main flavors is what we produce the most of. So there's black bean, nacho, pico de gallo, and then we've got salt and vinegar. Yeah, and then there's 2 plain ones. So I guess there's 6 really. The black bean chip just plain, and then the white bean chip just plain. And black bean chip plain is probably that and nacho are the 2 top sellers. So we produce a large, the largest amount of those. So currently we're just doing the sort of 5.5 ounce size, which is enough for 3 or 4 servings, or 2 servings of any normal person, because who can stop at a quarter of a bag of chips, right?
But anyway. I crushed the whole bag on Friday. We had movie night at my place, and crushed a whole bag of nacho. It went very well with some hummus that I'd also got. Oh. So anyways, great snack.
I thought you were going to tell me it went well with your beer or something, but yeah, it is really good. Well, the crazy thing about that is, of course, there's sodium, et cetera, in it, but in a single serving, which is like a third of a bag or so. I forget exactly. I think the way that the US reports it and Canada reports it is slightly different. That's why it's not completely top of mind. But you put away about 18 grams of protein, so you can feel good about that. Wow. And where can you get that in a chip? Like in all seriousness, as well as a tremendous amount of fiber, because beans are so high in fiber. So It's good for you. There you go. So the other thing I wanted to mention is we have a smaller size, 1.5 ounce single bag that they had just sort of really got going again during COVID. And we haven't been producing too many of those, but that's our next thing we're going to start really focusing on, because margins are even a little bit better with those. And the hospitality industry is crying for that. We've got lots of opportunities, let's just say, with quick serve restaurants and convenience stores, whether they're independents or chains, or you're on a road trip and you pop into the gas station. It's nice to be able to get something that you feel good about when you hit the other end of the road. Yeah. So and then we also have a 10 ounce bag as well, which we're currently in talks with some of the big box stores, et cetera. That's the size that appeals to them in maybe a 2-pack or something. So lots of opportunities and all of that stuff. The nice thing is it's already done. Like when you're starting a brand from scratch, it's so much work to even get the packaging created. I mean, you have you have an idea, but the audience probably doesn't know how long it takes to go back and forth and make sure every little thing is accurate on the packaging. And all that's done. All the flavor innovation has been done. And, like I said, we can tweak it slightly with if we want to, with extending the shelf life. But yeah, we're in very, very good shape. It's very exciting to have all this at the ready.
Sure. Now, I was reading one of your recent news releases. You're talking about the amount of, I think, monthly purchase orders that you're receiving. I think specifically for the Beanfields brand.
Yeah.
Sounded pretty sizable. I was talking about, if I'm not mistaken, around $800,000 US a month in sort of purchase orders received. So I guess in order to get a good fill rate on that, you're also going to need access to some further capital.
Yes.
Is that sort of the case?
Yes, exactly. So we aren't able to fulfill the 800,000 yet, but what we have done is, we're always fundraising for sure, but we're working on a number of vehicles to be able for us to be able to fulfill that. And we've got a really strong team in place, and we've got some really wonderful long-term investors that are well connected with the finance community, let's just say. So we feel confident for our next year that we'll be able to reach those numbers. And that is really just our current customer base. That's not even talking about all the opportunities that are out there, whether it's export, whether it's the whole 1.5 bag I just mentioned with the convenience sector. That's just filling our order. Right. So it's
I would imagine there's probably some pretty good food service opportunity with a single serve bag and something a little healthier than your typical sort of potato chip.
Yeah. You think about when you go pick up a sandwich or a burrito or whatever, right, and you get that little add-on.
You get the combo. I want some Beanfields chips with my sub sandwich.
Yes, excellent. Yeah, so we have had calls. We get calls from people that specialize in that service industry as far as brokers go, but we've had direct calls from some of the bigger, quick serve restaurants. So we know that there's a market there. There's no question. I mean,
I would imagine also like schools, universities, they're probably looking for healthier options. I know when I went to high school, we had like obviously a cafeteria and a store and everything, and they sold all sorts of junk that I'd never let my kids eat anymore. So I'm sure a lot of that stuff is modernizing, and a product like this, just on universities, colleges, and elementary and high school, probably pretty significant just right there. Huge market.
Absolutely.
Do you have any idea what the sort of total addressable market might be for sort of Beanfields? Like that, I would imagine it's got some, like you were saying, the 800,000 is really just existing customers. How many more customers? How much bigger could the brand sort of get, do you think?
Well, I mean, that is a good question. I do know that pre-pandemic they were doing 15 million, and that was just warming up. So I don't believe it's a stretch at all to say that in the next couple of years we should be able to get to 25 million. Obviously a lot of things have to fall into place to make that happen, right, because it's capital. It's a big machine. But now that we've done the hard work and the heavy lifting of making sure the margins are there and making sure that we've cut out all the overhead that's super unnecessary, huge consulting contracts they had before, very, very high paid employees, large staff. There's just a lot of things that we've done. Just even our packaging, new supplier is 38% cheaper. So there's so many things that we've done. And again, with the more volume you do, you start getting way better pricing on your beans, your rice, your spice, all of that. Even your logistics price goes down when you're doing volume, huge volume. So yeah, I feel confident that there's really a golden opportunity with this brand to continue to grow.
Great. And in terms of your co-manufacturing sort of model, is it scalable that you'd be able to sort of like meet a $25 million sort of year of business,
Yeah.
with your current co-man relationships?
Well, so far we have two co-manufacturers, and they're nowhere near at capacity. We would like to see by the time we're, let's say, starting to surpass that 15 million mark, we'll start looking to build our own facility. And the legacy team had done quite a bit of existing work on what that would look like. So we've got a good model to work from, and we have consultants as well that specialize in building out facilities. We know what the manufacturing equipment will cost and everything. So we'd love to do that. And it'll obviously provide further cost savings and better margins for us. And it would also represent our ability to co-manufacture for others, because the snack business is just on fire. I mean,
well, thanks for diving a bit more into it. I got a few more questions if you don't mind, and then we'll jump and get into something else.
Sure.
So out of this sort of purchase orders, and the brand's been around for a little while, and there was more of a focus on sort of top line rather than sort of profitability. How many total doors are you sort of carried in? How many retail locations carry the Beanfields product?
In North America, approximately 7,000 doors. So obviously that's primarily in the US, but a portion of that in Canada as well. So it's a lot of doors to fill, a lot of shelves.
Great. And are you in are you national with a couple of retailers, grocery and retail stores in the US?
Oh, absolutely. Whole Foods, Sprouts are our two biggest sellers in the natural channel. But then we're in Safeway, Meijer. There's a huge long list of retailers that carry us, and not all of them are national. Some of them are divisional, like Safeway, for instance. We opened in North California division, and they would like to take that national, but we need to fulfill our other orders first, because that's a lot of stores, right? So tremendous opportunity. And then Canada wide, we are in Sobeys and Whole Foods and Loblaws. Yeah, sorry, Loblaws.
Yeah. Great,
yes.
Great. So that, I guess that's a perfect segue into kind of the next question, talking a little bit about some of the company's growth strategy, including expansion into sort of new markets and some new products. It sounds like just in the retailers where you might be more regional, there might be national opportunity to sort of grow the number. And I guess at the same time, your team is also going to be analyzing where you're getting good turnover and sales, I guess what we call sales velocity, and looking to optimize that to those where you're seeing sort of the best turnover. Maybe you could just speak to, what are some of the growth strategies you envision if money was no issue and money got sorted out and you had adequate capital to be able to go out and build this $25 million a year business?
Yeah.
What are some of the growth strategies you'd sort of look to deploy?
Okay. Well, first of all, as I said, we need to make sure we fulfill the orders we have. And we've been doing that by sort of priority. We give our A clients first option because we want to maintain those relationships. The natural channel is very important to us. So just fulfilling is number one. Second is we've got a long list of retailers that are wanting the product. So we want to get to them. Because they've been very patient and good, and we do keep in good communication, and they're like, no worries, as soon as you're up, we want your chips. So we're happy about that. Then from there, we will, like I said earlier, we will look to expand into the hospitality division as well very quickly, because we're already just starting to produce those smaller packs. And they want the larger size too at convenience stores. So that requires a different distributor, which the legacy team had worked with. So we'll sort of amp up the distributors that we haven't been using in the US for hospitality that service the universities and big corporate offices in San Francisco. A lot of Google was a big account. So those kinds of customers. And then certainly we've got opportunities with, like I've mentioned, big box that we're waiting on. So that might be the larger pack that we start producing. So really just filling the sales, the backload of
Right.
sales.
So is that like a club channel?
That's right.
Obviously they, you can't go into one of those places and not walk out with a big bag of chips or popcorn. I noticed there's a bit of a gap. I haven't seen a bean chip lately, so
Yeah.
or ever. So that seems like
Yeah.
some low hanging fruit for you. Is that that can be a bit of a lengthy process in terms of presenting and get just with their model, and they usually want a custom product or a different sort of pack size. Have you guys been sort of planning for some of that and had some meetings already?
We're already working on that. We work with a broker that is specialized and has the developed really good relationships already. But we don't use a distributor, so there's a big cost savings there. And they're actually very good to work with. If you go to them with a presentation and they might say, well, we like it, but we need, because you have to do a completely different box for display purposes. We want a colored box, and something as small as that, you still got to tweak it. So, or we need more money for sampling. They have formulas that you fill. But it is a good program. The other nice thing about those kind of accounts is they are large orders up front. And so those types of accounts we can use purchase order funding for. So, it's a specialized, quick loan that they put the money up front and then they get paid. So that really helps our cash flow. And it's a nice chunk because an order like that can be, minimum.
They can be $1 million plus orders easily, and represent a pretty massive percentage of revenue for a brand that gets the model done right. So it sounds like you've got an experienced group that have ushered in a few brands, and hopefully you can ride on their coattails here and make that happen for Beanfields. I guess one of the things that I've heard a lot of chatter and spoken to some other recent sort of shareholders who I guess there might be a little confusion out there in terms of Beanfields sort of margin. There's sort of like your kind of gross margin between what you might be invoicing and selling it for, you're receiving purchase orders for, and then what you're actually reporting in terms of net sales on your financial statements. Obviously there's a few things within the industry. There's this thing called listing fees or trade spend. I'm not sure if a lot of investors really understand those things, but those are things that you can't sort of expense out in your list of company expenses. They have to get netted off first off of your sort of top line reported sort of net sales number on your public company financials. A bit unfortunate that you can't write off or expense those items, but I guess they count really more as like discounting of product. So in terms of maybe you could just sort of explain some of those things that you might sort of encounter as a CPG brand when you're looking to sell it into a wholesale, into sort of a retailer, and then there's a term that I tend to sort of use and is used a bit, and that is this thing called dead net. Is that something you could explain to investors as well?
So that's exactly right. What you're saying is all of those trade spends, et cetera, which we consider our marketing expenses, because truly they are. If we give it to Whole Foods and we have to buy an advertisement, let's just say in their flyer or any retailer, not necessarily them, but that could be $6,000 plus we have to give them 15% off as an example to move the product. Well, those are what we call, or we buy an end display, or all of those things are important aspects of how you market the product. So we don't spend money on radio advertising or magazine advertising at this point. We spend it in trade, but all those dollars, in my opinion, should come down under marketing expenses, but they do come off your top line, right? And so that becomes kind of deceiving a little bit, because private companies report their numbers totally differently. So, you know, they could say, well, we're doing 5 million. We did 5 million in sales. Well, we could be doing that, but we have to report it at 3.5 as an example, or something like that, because all those expenses coming off the top. So that part's a little frustrating, but it is what it is. And the more people understand that, the better it is for us to see. But those are just some of the expenses that come off the top. The distributors do have, the big distributors in the US, I'm going to say, are necessary at a certain stage of your growth, and potentially always. But it will be nice when we're in a position like some of the larger brands that you can do direct. And we're working on some of those relationships already with some of our retailers, because the distributor, they make a lot of money. So they charge you a lot. And of course, you know, the price of gas has gone up and all of those things. So it's not like you're going to cut out all that expense, but they have a tremendous amount of chargebacks.
Just to explain to investors, you typically have what's called like an everyday price, which would be your regular standard list price, and that would be what you're kind of invoiced on, or what you receive a purchase order and paid on. But then you also have some windows that the retailer wants to promote and offer a discount or a deal or a multi-buy or something to its shoppers to drive more volume through. And so when they do that, they want to maintain their margin. So they have the brand kind of contribute in something called trade spend. And that's why you can get chargebacks in their trade spend chargebacks, where they're basically recouping some of their original sort of cost to the product because they've decided to drop the price. And all that stuff is pre-negotiated and predetermined with the brand, correct?
That's right. So we were running on the previous legacy Beanfields contracts, because even though we did an asset purchase, the retailer just looks at it like the brand. So we're now kind of set up for the next year with our own system, which is much less onerous on the company. And it's going to help us dramatically reduce those costs.
And so what, if you were just dealing on pure gross, what you receive a PO versus what your COGS, what sort of margin are you sort of operating on today for Beanfields as an average?
So I'm going to keep the marketing in there for a minute, because I want to say outside of that trade spend, our margin, our profit margin with everything else in, including logistics, payroll, you name it, is between 40 and 42%. We're just fine tuning it because we're still in the process, but let's just say 40% as an example. The previous company was doing, with the trade spend, it was costing them around like high 30s, which is crazy. We've managed to get that down to 22%. And we're ish, again, it changes a little bit, because depending on when you've got promos running, we generally will say we'll give 15% off. We don't go above that. And so our net margin now we're working with after all of that is between 20 and 24% on that 800.
Right. Okay. So and so that's when you have a broker, you have a distributor. Between you and the retailer, you're sort of in the 20 to 24%, and that includes all your chargeback trade spend.
Yeah.
And
that's
so,
right.
And so I would imagine, for example, we won't use any specific retailer names, but you've got a couple of retailers where you're carried in, hundreds of their stores, and they represent a big reoccurring sort of, monthly sort of orders. There may be an opportunity to sort of, go direct, where they've got distribution centers. You don't have to go send trucks to every one of their retail stores. You can either have them pick up for their distribution, or you could ship in, offer a delivered price to their distribution center, and then let them sort of distribute into their stores. That tends to happen. They'll give warehouse space when a brand is kind of proven. So I imagine that you're probably getting to that point. where you can start to have some of that?
Yeah, exactly. And that's another area that our business manager is working on right now with some of our stores and developing those relationships. And you value your relationship with your distributor, but at the same time, every company has to do what they have to do to increase their profitability. And so now, as soon as we are able to reach these numbers, the purchase orders, we're in a much better position to do that. Because if we're able to say, there's no out of stock, we're fully, whatever you want, you get, then they're happy to talk to you about direct. And so that's definitely in our plan. And that's one of the things that will really help our margins as well, that we haven't factored into into our pro forma numbers that we'll be releasing soon. But they will definitely give a positive impact.
So if you were able to go direct, what would that do in terms of like your dead net margin? Would it improve it by 5 or 10%?
Well, I would say so. I don't have the exact numbers on that yet, because we don't have all the costs back for
sure
until we've got that firmed up. I don't want to.
No problem.
I don't want to say. Yeah, I don't want to say what.
Well, I'd certainly like to know at some point. So we'll have to do a follow up
for sure,
and sort of get that. Because again, from some of the involvement I have with other brands, as they do more regular sort of business with a retailer, they tend to look to go direct and try to reclaim some of the commission costs of brokers and some of the selling costs of distributors. And distributors, they can significantly mark up the product, so the retailer is paying a lot more for it, which is why they're seeking such a trade spend from the brand itself. It's just based upon distributor markup. So if you can go direct, it can also be beneficial for the retailer as well as the brand by giving them a better price, and then they're not having to seek as much trade spend from the brand itself. So it can be kind of a double whammy and really grab back a lot more margins. So anyways, sounds like there could be a good news story there. Sounds like you're already operating on pretty strong margins, dead net margins, by having a broker, distributor, retailer type distribution of product. I guess brands, are always sort of face sort of pricing competition and, from competitors. There's probably a couple of other competitors kind of in the space. How do you, as a brand, protect both the consumer and shareholders while maintaining margins for the business and keeping competitive prices? How do you sort of straddle that line?
Well, the thing is every food company is facing the same challenges in terms of cost increases in food and everything else. So if there's products out there that are less expensive than Beanfields right now, they might be using that as a strategy to gain market share, because Beanfields is a top selling bean chip and known for its quality. It also depends on the per ounce price too. Like sometimes it looks like a better deal, but it's a smaller pack and you get home and then you're mad. So we are working hard to keep our prices in line. And like I say, with regards to, working with consultants to do the direct model with pricing, working with a number of different raw material providers to get the best possible prices. We're talking with a very large logistics company right now that could potentially save us again additional monies in just our shipping from our warehouses to the district centers. So there's a lot of things at play. There's a lot of moving parts, and we've got a very dedicated, focused team. And I'm blessed to be surrounded by not only our small, mighty team in-house, but on my board of directors have a gentleman by the name of Mike Lund, who's been in the business for a long time. He's VP at Loblaws, senior executive with a number of food companies. So he's really good to come in to help with some of these bigger moves. and give advice, as well as other consultants that I talk to. There's a lot of help offered in this industry. It's very it's wonderful to see. You know, I can reach out to anybody in CEO in a competing company or in a you know, in the sector, in the natural sector. And it's tremendous how much information you can get and help. And I've done that since day one, and I'll keep doing it.
Great. So you mentioned a little earlier, you know, you used the P word, the profitable word.
Yeah.
What sort of monthly kind of revenues are you needing to do to become profitable under your current sort of, you know, framework of consultants and employees and current sort of estimated kind of costs? You know, what does the Pubco have to do in terms of monthly, you know, net sales in order to reach that sort of profitability, to get to that metric where you can decide if you want to continue to fund for growth, or you want to become a profit, or you want to maintain profitability? At what point does that sort of does that happen for you?
So once we were able to maintain, or once we were able to fulfill all of our purchase orders at that level in continuous sales, we're only about 90 days off of you know, just being at the break even. So we're, you know, we're really, really close. So 800,000 US.
So 800,000 US, and you're at the point where you could be profitable if you decided that you wanted to be a profitable business rather than reinvesting for growth.
Yeah. Yes, but that's going to take a few months at that level, because you know,
Sure.
when you've been sort of inching along through, like the past year, we've bootstrapped our way through, and we've still managed to do a good job of you know, growing the brand from where we were before we had it. So yeah, 3 months or so, and we're
sure on a monthly P&L though. Not taking into account anything other than your costs of running the business. Absolutely. At that point, you'd sort of reach profitability by just filling your current customers.
Yes.
Okay, that's good to know. We'll follow along and see how you do.
Yeah.
So as you know, and as you've been living through it, and I'm sure you've been pressed, you know, a lot of pressure, getting squeezed. CPG and plant-based food stocks have been, you know, absolutely pummeled in the last sort of 12 to 18 months.
Yeah.
It hasn't helped with names like Very Good Food Butcher having, you know, gone from, you know, $9 or $10 a share and, you know, almost $1 billion market cap to going bankrupt. You know, we're now starting to see a few green shoots out there. A couple of the smaller companies are, you know, started to see, you know, several 100% increase. Also, yourself, you've come off the lows significantly, trading some very high volume share days here. Do you think there's reason to be optimistic about the sector?
Yes, I think what happened was, you know, the over evaluations and the high expectations of you know, people switching to plant-based just like that, and the overspends. I mean, we had a completely different structure than a lot of the companies that have had their major challenges. We haven't spent money like that. So that's one thing, but you do get painted with the same brush regardless, and I understand that. It is going to take a while for people to change. Takes time with plant-based eating, and you know, most people are going to continue to eat meat, I think, and it's going to be a matter of making, if people make small changes, that dramatically increases the profitability of all these plant-based customers, and we are seeing that happen. But the nice thing about us, I think, is now that we have this other asset, and the main asset being Beanfields, is sure it's plant-based, and sure it's gluten-free, and sure it's better for you, but most importantly, it's just a really good snack, right? So it kind of, we're still in that plant-based sector, but moreover, we're salty snack category, right? So I think more and more of our marketing needs to potentially focus on that, so people get a truer sense of who we are as a company. And we do have plans in the works for that as well. So I do think it's going to take time for the plant-based as a sector to continue, and a lot of things had to shake out. But we feel excited about the future. Yeah.
I would imagine that being an executive and being really the face also of the public company, I would imagine it's been a bit of a tough space to be. Can you give investors just a bit of a vantage point into sort of your life over the last 6 to 12 months in terms of that?
Well, it's been intense. I'm not going to lie. It's my primary focus. I mean, I'm an entrepreneur, but my primary background has been sales, marketing, product development. That's who I am. I'm not a capital markets background person. Originally, we had a CEO that fulfilled that aspect of the business. So since his departure, all of that has come onto my plate as well. So you mentioned earlier, it's like two separate businesses, and that's exactly what it is. So we've got, I'm doing the capital raise, and it hasn't been the easiest year to be trying to raise money, especially in this sector, but it is getting better. I will say people are more enchanted. Us being finishing our year end, and then the progress we've made this second year, they're starting to see us as a valuable company to invest in and support. So I'm happy and excited about that. But the days are long, and the weeks go by quickly. And I've just learned a tremendous amount. I have great support. I have investors reaching out a lot, and I try to take as many calls and emails and that as I can. And I want to address their needs. And I certainly appreciate everybody that puts $1 into our company and sees us as someone they want to grow with. But I also hope that some of these investors see us as a long play, because we're just warming up and we're building a solid business here. And this is just the beginning of great things to come. And we've been through the worst of it. So I want to say, hang in there.
Right. Well, that kind of dovetails nicely into the next question I was going to ask. And that's, you've been seeing a tremendous amount of volume coming into your shares. You've seen sort of them increase dramatically from, sort of 1 or 2 cents a share to 10, 11 cents of a high. You're back down a little bit here, but you've had some days where you're trading 6, 7, 8 million shares. So you've seen a big turnover of your float, and you've brought on a bunch of new shareholders. I guess, what do you want to say to some of these new shareholders to give them a reason to sort of continue to hold, or maybe even acquire some more shares? You have a couple of key points you want to get across to them?
Well, I think in summary, we are building a strong company and a strong brand, and we have done all the hard work. I mean, we've been through the worst of it, cutting back our expenses as much as we have, building new relationships with new suppliers. All of those things have taken us this past year really to bring to fruition. And our year end is March 31st. And, we're going to be basically 4 times over last year, which I know is still low in terms of dollars, but it's something significant that we were able to do, bootstrapping and through all the chaos of 2022, right? So 2023 is, I guess it's our fiscal 2024 really starts April 1st. And we have tremendous plans. We have managed to keep all our main retailers, all the big retailers. We've got all their promo plans. All that work's been set out, distributors, better rates, all of these things that we've done. And we're going to start really seeing the benefit of that. And that's when I think that we'll start getting a true evaluation of what the company's really worth. Because right now, I don't think that our market cap really speaks to who we are and who we're definitely going to be. So stick with us.
Great. Well, that sort of about wraps it up for me. Those are probably some good last comments to sort of end on. Is there anything else you wanted to say before we wrap up?
Not really. I just appreciate the time. It's been great to have you, meet you, and all the new investors that we've seen come on. I'm very excited, and I do get some really wonderful encouragement, notes, and messages, and I just appreciate that so much because I'm happy to work hard. And so is our team, and we're not slowing down. We're just gonna keep up the volume and keep rocking and have a good time and build a strong company.